Module Overview. The International Financial Reporting Standards, IFRS, emerged in response to the growing need for a uniform set of global accounting principles. As globalization accelerated, businesses began operating across borders, and investors sought comparable financial information irrespective of a company's domicile. Historically, local GAAPs, generally accepted accounting principles, created significant variations in financial reporting, hindering international investment and cross-border mergers. To address this, the International Accounting Standards Committee, IASC, was formed in 1973 by a group of national accounting bodies. However, in 2001, the IASC was replaced by the International Accounting Standards Board, IASB, a more structured, independent, and globally recognized standard-setting authority. The IASB assumed responsibility for developing a comprehensive and enforceable set of standards, IFRS, with the goal of providing high-quality, transparent, and comparable financial reporting. The IFRS Foundation and the IASB. The IFRS Foundation is the oversight body that governs the IASB. Its mission is to develop a single set of high-quality global accounting standards, promote the use and rigorous application of those standards, consider the needs of emerging economies and SMEs, facilitate convergence with national accounting standards. The IASB, headquartered in London, consists of up to 14 full-time board members who are appointed based on technical competence and international experience. The board is supported by various committees. IFRS Interpretations Committee, IFRIC, issues interpretations of standards. Advisory Council, provides strategic advice. IFRS advisory bodies engage stakeholders globally. The IASB follows a transparent due process for issuing new standards, including discussion papers, exposure drafts, public consultations, and deliberations before final issuance. Objectives and importance of IFRS. The core objective of IFRS is to provide decision-useful information to a wide range of stakeholders, including investors, creditors, analysts, regulators, and the public. IFRS financial statements aim to be comparable across companies, countries, and time periods. Transparent, showing the true financial position of an entity. Reliable, based on neutral and verifiable data. Consistent, ensuring uniform application across entities and time. Key benefits of IFRS include enhanced investor confidence in financial statements, easier access to foreign capital markets, reduced cost of capital for multinational companies, improved corporate governance and accountability, simplified financial consolidation for multinationals. International financial reporting standards versus local generally accepted accounting principles, e.g., United States generally accepted accounting principles. International financial reporting standards is considered more principles-based, whereas systems like United States generally accepted accounting principles are rules-based. This fundamental difference impacts interpretation and flexibility. In this module, we will be using feature, IFRS, and USGAAP in our table. 1. Approach principles-based, rules-based. 2. Inventory costing FIFO, weighted AVG, no LIFO. FIFO, LIFO, weighted AVG. 3. Development costs, capitalized if criteria met, expensed as incurred. 4. Revaluation of assets permitted under some IFRS, not permitted. 5. Fair value use, widely applied, restricted, more conservative understanding. These differences is essential for multinational corporations and global investors. Global IFRS Adoption Map. As of 2025, over 140 jurisdictions require or permit IFRS for publicly listed companies. Some notable examples include EU countries, mandatory for consolidated financials of listed companies, Australia and Canada, full adoption of IFRS, Nigeria, South Africa, Kenya, mandatory for listed entities, United States, does not permit IFRS for domestic issuers but recognizes it for foreign filers. Challenges to global adoption include local tax and legal systems, resistance to change, infrastructure gaps in emerging markets, political and regulatory independence. Still, IFRS remains the most globally recognized financial language, increasingly forming the basis of multinational reporting. Case study: IFRS adoption in Nigeria. Background: Nigeria adopted IFRS in 2012 to improve its financial reporting quality and attract foreign investment. Outcomes: improved transparency in public entities, increased investor confidence, reduction in financial manipulation. Challenges faced: cost of training professionals, initial confusion between IFRS and local laws, need for consistent enforcement. This case illustrates the importance of training, regulatory alignment, and public-private cooperation in successful IFRS implementation. Summary of key takeaways. International Financial Reporting Standards was developed by the International Accounting Standards Board to provide a global framework for financial reporting. The IFRS Foundation oversees the work of the IASB and ensures transparent standard setting. IFRS promotes comparability, transparency, and investor confidence. Adoption is widespread but not yet universal. Understanding IFRS versus local GAAP is essential for global accounting professionals.